All right. So good evening, everybody. And for those that are jumping on afterwards, if you need us to repeat anything, just shout and interrupt, and we'll go back over it. But thanks everyone for joining tonight. As we've been blasting out over the past couple of weeks, the meeting tonight is really going to be focused on planning and planning for the next generation. So we're going to hit a few topics like retirement planning, college planning, buying versus renting. I'm going to go ahead and mute everyone. So retirement planning, college planning, we'll talk about renting versus buying, and some charitable planning strategies too. Hopefully you all will find at least some of this interesting. Many of you who I already know are on the call, you don't need much retirement planning because you're already there, you're already retired. But if you have friends, family, anyone who this might be useful information for, you can of course pass the info along to them, and we'll have this recorded and we can send this out to everyone afterwards as well. But before we get into everything, I just want to introduce myself, Rob D'Angelo. I have my colleague, Lauren Taylor, on the line as well. And we'll just give a quick introduction. So I'm a financial advisor here at Altrius, for those that don't know me. I've been at the company for about 2.5 years. And prior to that, I was in New Jersey and worked in Manhattan for about 11 years. All my career has been in wealth management, so working with high net worth individual investors and their families, and helping find solutions for whatever financial problems they have. It's been a great time joining Altrius so far. Love living in North Carolina. Don't miss the North, especially around this time of year when it's cold and snowing and all that stuff. But very much enjoying the time here, and I'll hand it over to Lauren, and she can give a little intro about herself too. Still on mute. All right, well, here's how it'll go. So we have a few different sections of the presentation tonight. So I'm going to cover and jump into a few areas of just key financial planning topics. And then from there, Lauren is going to hop on and she's going to give an overview of our planning platform. So we use eMoney. I know a bunch of people on the call log on to their profile and check their information on eMoney every now and then. For those that haven't gone on or been on it yet, Lauren will go through the different sections there and show you what is useful and the different tools that you have at your disposal. And then I'll jump back on and I'll go through a case study of a baseline plan that I've actually built for a client last year. And I'll just show you how we kind of think about planning and what goes into it, what the reports look like, and then from there we'll open it up to Q&A if anybody has any questions or wants us to talk about anything in more detail. So without further ado, and also too, I have everyone muted just for convenience. There is a chat feature here. Just look for a little chat bubble. If you have a question, type it in. And we'll check in periodically for questions as well. But here, let me go ahead and share my screen. All right. So hopefully everyone can see this here. I'll try to make it a little bit bigger. All right, so one of the big reasons that I'm doing this is I get questions from clients and people all the time. When should I retire? How much do I need? All that stuff. And usually I kind of give a funny, sarcastic answer at first. And I'm like, well, tell me how much you need to live every year and when you're going to die. And then I could get pretty close to a ballpark amount with how much you need. But it's a lot more nuanced than that. So everyone has, everyone's situation is different. Everyone has their unique circumstances and different goals and objectives that they're trying to achieve with their money. And one of the things I like best about my job is working with those people and trying to help them figure out what their goals are, what their objectives are, and then putting together a plan for them to help achieve those goals. Because I've seen a lot go wrong with clients without having that plan. I talk about, I've told this story a lot to people that I've been working with since moving to Altrius, and financial planning, it really has, there's no golden number that you need to reach in order to have financial freedom or to retire or anything like that. I mean, I've worked with clients when I was in New York that had, 10, 15, $20 million. And on the surface, that sounds great. And when I would go through and build out a plan for them, they would run out of money in 10 years, or they would be broke, or they wouldn't have enough to retire. And they'd have to, work forever unless they made some pretty substantial changes. So having a plan together is really important. And when I'm building one for a client, I always try to establish that plan is really what the benchmark should be for how you think about your investment success. Not as much, hey, my account's down, the S&P is up, or my account's up, the S&P is down, or the bond index is high or low. Performance is going to come and go. It's a cyclical business. It's a cyclical industry, but having a plan and knowing where you are on that plan, and if you're on track to accomplish what you want to accomplish, I think is the most important thing. So like I said before, take you through a few key items to think about when it comes to financial planning, and then we'll go from there. So the first big topic is retirement planning. And why is that important? It's pretty important because people want to retire, right? Their goals are accumulate enough assets as you're working, and then have enough to live off of without having an income coming in anymore. And the power of that is, you start a retirement fund or retirement program when you're young, and the power of compounding is real. So compound interest, compound annual gains, annual returns, that's all really powerful. Basically what that means is you start with a little amount in your savings account, and you keep doing it, and you keep it invested, and it keeps growing over time. And those little amounts over a 20, 30, 40-year investment period become really big. I often say there's no magic bullet in investing. If there was a magic bullet at all, it would be compound annual return. It's a really powerful thing. Another great advantage of a retirement plan is you get tax deferred growth, or tax-free growth if you have a Roth account. And all of these things together help you achieve long-term financial stability. So the ways that you save, many of you know this already because you've done it and you're retired. So excuse me if it's redundant, but employer plans are great. So that is a retirement plan like a 401k, 403b, TSP if you're in the military or work for the government, SEP IRAs, simple IRAs if you're an entrepreneur or a solo practitioner. Same with the solo 401k, which is the same as an employer-sponsored 401k, pretty much in every way, except it's for individuals that have no employees. They're a solo worker. And in all of these vehicles, for the most part, you have the options to invest in a pre-tax vehicle or an after-tax vehicle, which is a Roth. So pre-tax, obviously that means anything you put in is coming out before any of your earnings are taxed. Roth, on the other hand, you go through your taxes, whatever your net earnings are, the amounts that you're putting into the Roth go in after tax, and those grow 100% tax-free. Clients often ask, how much should I save? Should it be 10%, 5%? Should I hit the max? I say the one thing you should make sure that you're doing is putting in enough to your employer-sponsored plans to where you're getting a company match. So if your company is willing to match 4 or 5%, put in at least 4 or 5% so you get that full match. If you're not doing that, then you're literally throwing out free money. So take advantage of things like that. And then from there, I think it starts with really what a personal budget is. Ideally, everyone can put in the max, and I've included the limits for 2022 below, which have increased a little bit for most plans. But it really starts with what your personal goals, objectives are, and what it is you want to achieve with your money, and what your means are. Some people can't put the max in, which is $20,500 next year for a 401k. They can put in a little bit less, and they want to build up cash or investments outside for other reasons. So examine your personal financial situation first. Work with someone that you trust. Talk to someone that you trust, and then you could figure it out with a little bit of financial planning. Some key things to consider that have, as we're thinking and talking about financial planning. If you're inheriting an IRA or any beneficiaries you name that might inherit an IRA one day, some rules changed at the end of 2019, beginning of 2020, to where those inherited IRAs need to be zeroed out within 10 years of inheriting them. So there could be some tax implications there if it's a traditional IRA that they're inheriting. Even though there are no tax implications or tax benefits to the government in a inherited Roth IRA account, those Roth IRA accounts also still must be zeroed out in 10 years. On the other side, if you're older and you're still working, there is no age limit to be able to contribute to an IRA anymore. So that was one nice thing that the IRS changed, where if you have that earned income coming in your older years, you can still contribute to your IRA. If you want to convert any of your traditional pre-tax IRAs from to a Roth, you can do that at any time, but just keep in mind taxes. So anything that you convert is going to be taxed at ordinary income rates. So having a plan to pay those taxes versus having those taxes withheld from the amount that you're converting, I think is always important to have too. And there's a couple different Roth IRA options for people who make a lot of money, because there are income levels where you're phased out of being able to contribute to a Roth IRA. So you may be in a position where you can take advantage of a backdoor Roth IRA or a mega backdoor Roth IRA. I could talk more about those in detail if anyone has any questions. There are some things to keep in mind, some pitfalls to be aware of, where it might not always make sense in someone's situation to execute on a backdoor Roth IRA strategy. But happy to talk more about that as well if anyone has specific questions. Next big financial planning topic is 529 plans and saving for college. So a 529 plan, for those that don't know, college savings plan offers certain tax benefits. The biggest one being any money that you contribute to the 529 plan grows 100% tax-free as long as what you're using the money for when you're making withdrawals is directly for higher education expenses. So there's a little history that we provide in this packet about 529 plans. They are a huge vehicle these days. 14 million accounts across the U.S. And approaching $500 billion in assets. And we all know the story here. College costs have been increasing like crazy at an annualized rate over the past 20 years of about 6%. Across the board, that's whether that's in-state or out-of-state. We use UNC Chapel Hill as an example here, where it shows today's all-in costs are about $21,500 in-state. Out-of-state, that goes up to about $48,500. And we use some other colleges here just to show what the approximate current expenses are. NC State, similar to UNC. Duke, you're paying $60,000 a year. Michigan, they had a big win over the weekend. Chris might be, our other advisor, Chris might be listening and still excited about that, but you're paying a lot to go to that school. Harvard, even Rutgers, so back in Jersey, In state, you're still getting a benefit. It's about $29,000. Out of state, you're paying a lot more, $45,000. So many people have on their mind, how am I going to save to help my kids pay for school? And a 529 is a great way to do that. Like I said, tax-free growth if all the withdrawals go towards higher education expenses, and you have the investment potential to exceed the cost of price inflation, which is about 6% or so, as we've seen. Anyone can contribute to a 529. It's owned by a parent or a guardian or a friend, so it doesn't have any effect on financial aid for that student or for that child. You might get some state tax deductions too. There are some states still offering state tax deductions. North Carolina doesn't anymore, so there's no benefit to, there's no per se tax benefit to investing in a North Carolina 529 plan. So you can pick a plan that you like instead. And then the amounts that you can contribute to a 529. So the gifting amount is increasing for 2022 for it's going to be $16,000 per person. And that increased from $15,000 in 2021. So a married couple can contribute up to $32,000 per year per child without triggering a gift tax return, which is nice. 529s, you also have the option to front load a 529. And what I mean by that is you can put up to 5 years of gifts into a 529 up front, as long as you're not contributing to it again over the preceding 5 years. So a married couple can put up to $160,000 in for a child in year one, and let that ride and let that invest for the next 5 years before they can contribute again. With all of this, the more that you can invest, the earlier on, the more likely it is that you'll be able to achieve a long-term goal. Again, because that means the power of compounding really comes into play over longer periods of time. And over longer periods of time, it's less likely that you're going to experience a negative return. So doing as much as you can, as early as you can, taking advantage of a long time horizon really goes a long way towards helping achieve some financial goals. Some downsides to saving for 529 plans. Earnings are subject to income tax and the 10% penalty if it's not for a qualified expense. So again, keeping that money there earmarked for higher education expenses is important, or else you're going to be hit with some penalties there. Investment options may be limited depending on which plan you invest in. Advisor direct plans or advisor sold plans versus direct plans might have some higher fees. And the individual funds options might also have fees embedded in them as well. That varies state by state, depending on who the plan sponsor is and how you're investing. So all kind of things to keep in mind as you're checking out different plans and what might be right and a good fit for you. So I think I saw a question here about what you might use 529 plans for. So any qualified expenses, tuition, room and board, you can use it for K through 12 private school, only up to a maximum of $10,000 per year. So if your tuition is more than that at a private school, that's right now, that's all you can do. Books, supplies, student loan payments. Again, student loan payments is also capped at $10,000 a year per child. So you can't do anything like travel, transportation, health insurance, applications, extracurriculars. None of those are qualifying expenses. Rob, off the top of my head, I think Lauren just answered your question here. So trade schools, yep, are included as a qualified institution. If you have leftover money in a 529 after a child graduates, and you don't want to pay the tax and withdraw that money, you can do a couple things. You could change the beneficiary at any time. to a grandchild, a niece, nephew, neighbor, friend, anyone that you want. You could change the beneficiary. Or you could save the funds for graduate school, master's degree, MBAs, all of those types of things, PhDs, all of those types of degrees. You can use those funds to help pay for those costs as well. And here we just include a little case study, basically showing how much you need to save if you're having a child and you think they're going to go to school when they're 18, assuming investment growth of around 7% and college cost increase of around 5% for an in-state, I think this is based on North Carolina, college tuition costs. So for in-state, you need to save about $6,000 a year per child, or about $500 a month. Out of state is getting closer to $14,000 per year, or a little over almost $1,200 a month. So again, working with an advisor can be very useful for mapping out these college plans. We use eMoney. Again, Lauren will show you eMoney, but we can do a lot of planning on that system and help map out how much you need to save based on what you're trying to achieve. I'm going to unmute it real quick just to see if there are any questions before I move on here. Any questions?
I'm just going to take the opportunity to test. Can you hear me?
Yes.
Okay, perfect. All right, all good.
All right. So a couple more things, and then I'll hand it over to Lauren. So mortgage rates and refinancing. So this is a chart going back a long ways here to show what's been going on with the mortgage rates over time. So they've been coming down, way down, and you could see that as of the last reading, which I think was the 24th of November, which is where these rates are, the national average for the 30 years is 3.1%, and the average for the 15 is 2.4. So a lot of clients are asking, hey, do I refinance? Younger clients are asking, hey, do I buy something, take advantage of the low rates versus renting? All good questions. If you currently own and you haven't refinanced yet, it's probably worth taking a look at because rates have come down even in the past couple of years, where that might make a lot of sense. You could save a lot in interest by refinancing, and you have a quick break-even period, depending on how much your closing costs would be to refinance and all that. But when, this is a little case study for refinancing. So it just shows, hey, if you bought a home about 15 years ago for $500,000, put 20% down, you had a $400,000 loan, 30-year fixed back in 06, you could probably get for just under 6.2%. So after 15 years, your loan balance is just under $290. You're paying about a little under $2,500 a month. The remaining interest over those next 15 years is about $153,000. If you were to refinance to a new 15-year and take advantage of the 2.4% interest rate, your monthly payment would go down by about $500. You would save about $100,000 in interest over the remaining 15 years. If we assume closing costs around $6,000, that break even is around 11 months. Just threw a 20-year in just for interest too. So your payment would be reduced to around 1.6%. The remaining interest over that lifetime is around $101,000. So you're still saving around $52,000 in interest over those next 15 years. And your break-even period there is about 7 months. So just straight line example why it might make sense for someone who hasn't refinanced yet to at least think about it and crunch some numbers. And then the question about renting versus owning, it's really not just about money. Owning doesn't always make sense. More than, people say renting is just throwing away money. I'm not building equity. I'm not investing in anything. That's not necessarily true. I mean, everyone needs a place to live. Everyone needs a roof over your head. You're going to pay for that in some way, in some shape or form, no matter how you slice it. So there are a lot of examples out there and articles and studies that I've read where it shows the overall cost of renting tends to be lower than owning. I know a lot of homeowners here on this call. Homeownership can be expensive, and you're not always guaranteed to have your home increase in value over time. Even if it does, the amount that it's growing in value is not going to exceed anywhere close to what you get in the stock market. So there are oftentimes a lot of opportunity costs with putting a big chunk of capital in as a down payment for a house. Yeah, you have equity and you have the potential to build equity. And as the home grows in value, that helps grow your equity too. But that chunk of money that you're putting into your house it's locked in the house. There are ways to get it out, but you're still going to tap into some type of loan to take that money out. So having that money work for you in another capacity to be invested in the market or help accomplish another financial goal or objective could be important for you too. So there's no necessarily right or wrong answer when it comes to renting versus owning. Really depends on your personal situation. And that's where working with an advisor or speaking with someone that you trust can help, flesh out what makes the most sense for you and your situation. And I also hear this too. So owning just to take advantage of the tax write-off. Well, with the tax changes that came in 2018, if you're only taking the standard deduction and you're not itemizing your deductions, then owning a house just for a tax write-off doesn't really make sense at all, because you're not itemizing. You don't have enough deductions to take advantage of what you would get as a write-off on your mortgage interest. And that, even if you do itemize, the amount that you can write off or your mortgage deduction or mortgage interest deduction will go down over time too. That's just based on the amortization table. So as you're paying down your mortgage, less goes to interest, more goes to principal over time. So I don't necessarily think that in every case it makes sense to own a house just for a tax write-off. Again, really important just to examine all of this and how it affects your own personal situation. Okay, last topic here. So charitable giving. That's something that a lot of our clients feel important about. A lot of younger people, believe it or not, are philanthropic and want to put their money towards good causes as well. So it's a question we get a lot. Some basic framework, at least how I think about it and talk about it with clients. Build it into your lifestyle. Make it something that's important to you. And then I would say, make sure that you're thinking about charitable giving using surplus funds first. So mapping out what is surplus versus what it is that you need to maintain your core lifestyle is something that can be done with financial planning and working with a financial advisor. So it's important to think about it that way too. You obviously don't want to risk losing your own roof or not being able to pay for a tuition payment just because you want to make a donation to a charity that's important. So there are a number of ways to donate. You could use assets, stocks, bonds, cash, real estate. You can build and create a charitable trust. Donor advised funds have become very popular over the past decade. Private foundations are also another vehicle that you can capitalize on charitable giving. Those tend to be costly. There are more rules that you need to follow in order to maintain a tax-exempt status for a private foundation. A donor advised fund streamlines some of those things. If none of these are familiar to you and you want to speak about them further, reach out. Happy to take a deeper dive into each one. And the big thing to consider with charitable giving is definitely taxes. So again, you can claim charitable deductions if you're itemizing your deductions. If you're only taking the standard deduction, then it doesn't make sense. You're not gonna be able to take that charitable deduction. And usually the charitable deductions that you can take are limited to anywhere from 20 to 60% of your total adjusted gross income. For 2021, Interestingly, there was a carryover from rule changes in 2020, where if you're making cash donations, you can deduct up to 100% of your AGI. Again, that's just for 2021. 2022, that goes away. And if you're donating any capital gain property, stocks, bonds, real estate, anything like that, that is still subject to a 30% of your AGI cap. Also, always a good idea, keep records, keep receipts, even if it's a small amount, $200, $250, $500. Take pictures if you're donating clothing items or jewelry. All that's important. While the risks of audits have come way down over the past couple of decades, it still can happen, and having a record could help you save a massive headache. And that's it for me and some key planning topics here. I will now hand it over to Lauren. Let me make you a presenter here, Lauren. I think you're still muted, Lauren. Nope. No, as Lauren's fixing her audio, we had a question come in what circumstance does it make sense to donate stocks to a charity instead of cash? Great question. It might make sense. So if you have really low cost basis stock, let's say you hit a home run and you were investing in Apple in the early 90s, and you own, your cost basis on Apple is a few dollars a share. Well, now the cost of Apple is like $160 a share. So you have a big unrealized capital gain there. Instead of selling those shares and being hit with a 20% federal capital gains tax bill, you could donate highly appreciated shares to a charity, and that helps you avoid paying capital gain on the shares that you donate. And when the charity or the institution you're donating to receives those shares, they can sell them for no tax, no capital gain consequence, and use the funds as needed. So it is a tax benefit there, and it also could help you diversify out of some highly appreciated stock that you have that you might not want to sell because of those tax implications.
Hey, Rob, do you still have everyone muted right now?
I do.
I'm thinking that's why Lauren might not be able, might not be able to hear her if you have the whole audience muted.
Net worth, $2 million.
Can you hear me?
Now we can hear you, Lauren. Yep.
Yes.
Okay.
Now, Lauren, you're the organizer too, so I think you can mute everyone's line too.
Okay, is that better? Good, okay. Let me see if I can get back to unpausing my screen. All right, so here we are. Well, I get the lovely task of talking to you about how cool eMoney is. This would be your home page when you log in, and it really is, when you think about eMoney, you can think of it as your financial health report. Everything that is dealing with your life financially, you can edit and enter as a data point here, and it wraps it up in a pretty bow and draws you a picture. So you can look here. We have different accounts that you can add. You can add your savings account, any credit cards that you have, any investments that you have, life insurance, and it comes all together and gives you your net worth and your investments, and here your goals. This is probably one of the most important things on eMoney for our clients, because it gives you a quick look at whether or not you're on track for the things that you're planning for. So Rob spoke about 529 plans. You have the ability to edit and enter those here, and it shows you, yes, Mary Beth's college is fully funded, but I might need to make some adjustments here for retiring at a certain age. When you're looking at the certain tabs in our organizer, you have the ability to go through and add anyone that might be related to you that you're supporting, like your spouse, your children. Also, any contacts, professional contacts like your CPA. You can come here and add that person. And this is helpful for all of eMoney. Is helpful to your advisor because it allows us to have a full, clear picture of what's going on with you and what you might need, so that we can provide the best possible service for you and to you. So again, looking at the goals, it draws you a pretty picture of your goals. Let's say I wanted to purchase a new car, which I do not need. I could come here, add my new car, say when I want to buy it, I'll buy it next year, and it's going to cost me about 50 grand. Then I would come to the bottom and I could see, here's my goal. I need to figure out how I'm going to fund it. And I would just choose from the accounts that I'd previously entered in. This entering in your accounts will probably take you about 10, 15 minutes, but it's really good to have everything linked, because if you're like me, then you have logins for several different places. We've got a couple of bank accounts, we've got other accounts, and it's really nice to have everything all in one spot. On the investment tab, you have the ability to see, if you're a new client with us at Altruist, we automatically will set this up and link your accounts with us. So that'll show on your investments tab. But if you have outside accounts, also you can link those as well, and they'll feed into this here as well. And again, it's a good thing if you have outside accounts to link them, because again, it gives us a clear picture of what you need and what you're dealing with, so we can provide the best possible service. In your vault, this is super, super, super important, because each client will have an investments folder where we will store your quarterly reports, and any new account paperwork, we'll redact it and put it in here for you, so you can always have it. The cool thing about this area is Rob mentioned that it would be a good idea for you to take pictures of things that you're giving away as charitable donations, or records of your charitable donations. I can create, or you can create, a folder create here, and you can just throw all of your records in this folder and it'll be here for you. We've had a client who needed to get us some information quickly. They were traveling. They already had the files uploaded on their cloud. All they had to do was just drag it over into eMoney. Boom, we had it. Quick and easy. On the reports tab, if you're here, if you're at the point where you're looking at different reports, know that your advisor, Rob, Chris, we're holding your hand through this. So I won't spend a lot of time on this screen, but I would, if you could bear with me, I'd like to show you some tabs that I skipped over, because when reviewing samples, they don't allow you to see everything, and I really wanted to give you a good idea of what was going on. So, bear with me here. Okay, so here we have Lady Sample, and Lady Sample does not use eMoney the way that she should. We're going to slap her wrist for that. But when she gets the time and she adds all of her accounts, she'll go over to the spending tab, and if you're able to put in and track all of your spending, eMoney has a technology that will, over time, create a budget for you, and that's always good to have, just to keep you on track with your goals. Your advisor, we will never have permission to view your spending data, so you don't have to worry about privacy or anything like that. Also, with the vault, if you wanted to lock certain folders that you created, you had that capability as well. Again, all of this feeds back into your home page and gives you that pretty picture. And again, it just really is helpful for your advisor when we're planning. Also, it has what feeds into the advisor side. It really allows Rob to dig in and create a personalized plan for you. So you're not just looking at a basic overview of, something that could be used for anyone. It's really catered and personalized to you, and you're able to see it that way. So that is, in a nutshell, eMoney. Were there any questions for anyone so far? Oh, all good? Okay, well, with that, I will hand it back over to Rob.
Yeah, Lauren, thank you. Just stay on this page 1 second. Before I started the presentation talking about using the plan and thinking about your own specific plan as your benchmark for your financial success, if you see these bars here, that's really what I'm talking about. So as we all know, the market's going to fluctuate every day. Your account values are going to fluctuate every day. You have goals that you're looking to accomplish with your money that are out into the future. So if we look at an example like today, and this is just a sample client, so the goals and the plans that we're building for clients, we want to build a client a plan that is successful. Just go back real quick to just to that bar. So on a day like today, when the market was down 1.5%, 2%, and you're looking at that in your account, it's going to look like the world is ending. But if you come to eMoney and you evaluate how your plan looks in that context, your long-term plan, yeah, the market might be down 1.5%, 2% on any given day, but you're going to come onto eMoney and you're going to say, oh, my retirement goal, where I'm planning to be retired for 35 plus years, that goal is still green. Or I want to pay for my daughter's college here. What happened in the market today, being down a couple percent, is not impacting that goal that I need for the next 3 years. That's why I think it's such an important thing to have in place before you start investing. The fact of the matter is, it's never been easier to invest $1 today in today's day and age. There's a number of platforms out there. You could sign up, link your bank account, start buying shares of stuff in a matter of minutes. And that access is great, and it does empower a lot of people that didn't have that ability just some years ago. But if you're investing and you're doing those things without knowing why you're doing them or without having a plan in place, I mean, you might as well just go to the casino and play some roulette too. It's essentially the same thing. Having that plan, having those objectives in place makes it a lot easier than to put together a custom portfolio that's balanced in terms of stocks, bonds, to help you achieve those goals. A couple chat questions here before I show an example. Charitable deductions on top of the standard deduction for 21 and 22. I didn't see if that came out for 2022 yet, if they extended that. I know that that is correct. So you can deduct for, again, cash donations, not stocks, not bonds, but cash donations. The limits are actually 300 per individual and 600 per couple. At least that's what I saw for 2021 on top of the standard deduction. So again, if you don't have the ability to itemize, and you're still giving to charity, married couple can still deduct $600 of their charitable donations on top of just the standard deduction. Let's see. Proposals by government to tax unrealized capital gains. Does it make sense to move over to a Roth sooner? So until that legislation comes out and we see, it's really hard to say if converting to a Roth makes sense. Fact of the matter is, you have assets in a Roth, you're still going to have a lot of unrealized gains in a Roth account too. I haven't seen anything that the government or people in Congress have an opinion one way or another on unrealized gains being at play in a Roth IRA as well. So really not so sure. Monte Carlo analysis, yep, we do. So in the financial plans that we build as advisors, me, Chris, Jim, Greg, Annie, so we do incorporate Monte Carlo analysis. That's how we evaluate the strength of a plan. And I'll show you that here in a minute. And then the AGI, so Roth IRA contributions, when do they phase out? How much do you have to make? I don't know the exact numbers off the top of my head. I think it's around $215,000 for a married couple in terms of earned income, to where you can no longer contribute to a Roth IRA. For an individual, I think it's around 150 or so. But I can double check those numbers and send them around. Any other questions before I show you what a plan looks like? All right. All right. So like I said, this was a plan for a client. So before they became a client, worked with them in putting together a baseline plan. So this was last summer. And then this is at least how I put them together. We all kind of have our own take on them. Jim might do it a little bit differently. Chris might do a little bit differently. But this is the way that I put them together. So the first page is always facts about the person and the situation and the inputs that I put into the plan. So this is a relatively younger couple who they reside in Whoville, a little holiday spirit there. They have 2 young kids, a daughter, 4, and a son 2. They have some 529s. They're not really sure about what they want to do in terms of college planning. They said they want their kids to have some skin in the game. They might just fund their education with loans. Again, everyone's different, so we didn't incorporate any college planning into this baseline plan, something that'll work with them going forward. But they have about $500,000 in investable assets, 160,000 or so in tax deferred retirement vehicles, a lot of money just sitting in cash. And then they make some good money too. So the client, she's a surgeon at a hospital. So she makes about $256,000 a year, wants to retire in about 15 years. She's maxing out her 401k. The system picks up Social Security automatically based on income. And then the husband is an entrepreneur, runs his own business, does hunting, fishing, charters, and lessons, makes about $45,000 a year, modeling him making maximum contributions to an IRA. Picks up his Social Security benefits as well. In order to make the plan, the baseline plan, successful, as you can see, they make really good money. They don't have a lot in terms of investable assets yet, and they definitely have a lot of cash. I put in here an assumption in a model that they're going to save an additional $25,000 a year into a taxable joint investment account. And we have in here that they spend about $90,000 a year. I take plans out to when people turn 90. That's a long time horizon for these folks. I'm always trying to plan conservatively too. So these clients came back and they told me, hey, we really only spend about $6,000 a month, about $72,000 a year. As long as I've been doing this, people classically underestimate how much they spend. They overestimate how much they think they're going to get from investment returns. So I usually put some premium or add some amount on living expenses to really stress test what the situation is. Because if I could help a client get to a positive result, assuming higher than normal expenses, lower than average returns, poor markets for decades on end, then that goes a long way towards providing that client with financial security. So these are these clients. So this is their situation. Next page, I always kind of lay out for them what their net worth is and lay it out here. And here's the Monte Carlo summary. So here is how we evaluate the strength of the plan. And what I said before, wanting to be conservative as an advisor, as a fiduciary when it comes to planning, I am always focused on this downside number. This downside number here assumes that there are terrible markets year in and year out for the whole life of the plan. So this plan looks at a timeline going out to 2074, really long plan. So between now and 2074, we're going to have below average markets every year. That's what this downside number is. I wish I could black out these upside numbers. I don't want clients to look at them at all. It's exciting to look at. Yeah, you might have $11 million by the time you're in your 70s, 80s, 90s. That's all great. If we have that, if we have great markets every year for 30, 40 years, fantastic. As your advisor, I would be happy to help you spend more money and have more fun. That's never a problem for me. As your advisor, as your fiduciary, I'm trying to get you to a place where if we have really bad assumptions and things go wrong for really extended periods of time, but you are still okay, you're still able to maintain a nice quality of life in retirement. You don't have to go back to work. You can pay for your kids' school. You can pay off your loans and all of that. That's what's important to me. So this is where you see how your situation is stress tested, how it looks with different assumptions and different market assumptions. And the other thing I do here too is in these models, I'm using a portfolio and an investment portfolio. It's all indexes. I should say that first. It's all index returns on all of these financial planning software applications. It's not Altrius returns. It's not our investments, our stocks, and our bonds. But I'm using a basket of returns that is generating, on average, about a 5% return per year. Fairly conservative. So if we have young clients like these clients are, who are actually now in an all stock portfolio, they can expect that over a 20, 30 year time horizon, it's very likely that their return over those 20 or 30 years is going to be higher than 5%, which makes the results on this page look even better. But again, using a conservative basket of investments to model these plans in just helps you be more conservative. It plans for a lower return environment. And if it happens that is the case, then there's still a high degree of confidence that you're going to have a successful plan. So that is what the Monte Carlo is. And then this is just another way to look at it. So it gives some more statistics on the different trials that are in the Monte Carlo. So you see, out of the 1,000 trials and the 1,000 simulations that eMoney runs this client's situation through, the lowest number that generated in those 1,000 trials was negative 800,000. That was 1 out of 1,000 trials. So for 980 of the trials, they were, at least positive in terms of how much they had by the time the younger of the two is 90. And that's the result that we're looking for. Another interesting report that clients like to look at here too are the inflation, or I'm sorry, not inflation. We got a question about inflation, so just saw that pop up, but the cash flow pages. So you could see year in and year out what you have coming in, what you have going out, planned savings. Are you net cash flow positive or negative, and what the total portfolio assets are. The one thing I'll say about the cash flow pages, so Monte Carlo can't be included in the cash flow pages. So these aren't stress tested numbers. This assumes a fixed rate of return on your assets every year after expenses. So again, I use that number. I use that basket of investments. That's a 5% annual return. That's what you're seeing here. And if depending on the client, I can click into each one of these columns as well and dive deeper into the different numbers and what's coming in a specific year, what's going out in a specific year. And you could see kind of on a more itemized basis what the individual expense numbers are and income numbers are. But another interesting chart that a lot of clients like to look at as well. And then from there, it's a lot of disclosures. Obviously, past returns don't guarantee future results. This is the income basket that I use here. So you can see it generates about a 5% rate of return. 5% of the model that I use is in 30-day T-bills, basically cash. 1 to 3 year Treasury bonds. That's 35% of the allocation that I'm using here. So again, really a conservative basket. And that's that. Again, we can use all different types of return assumptions. We can model a lot more than what's just here in the baseline, in the client's baseline plan. We do a lot of college planning. For a lot of my clients that have kids, they do want to be able to help them pay for college one day. So that's usually a part of most plans that we're doing here. Charitable giving, I've done plans for. We have clients, executives at tech companies that get stock options and restricted stock. We're able to model those in here and find an optimal time to sell them based on taxes and all of that stuff. So we can do a lot of specialized, tailored financial planning on eMoney. So it's the part of my job that I like the most. I think it builds a really strong relationship between advisor and client, and it gets everyone on the same page. So before I open it up to questions again, let's see, one question on inflation here. So the system, eMoney, it hasn't updated their inflation assumptions yet, as we've kind of seen a tick up in inflation over the past year or so. So their inflation number is still 2.6%. What I do when I go into planning is building more conservative features into the plan. If you see, go back to the facts here, when it comes to income, when a client's saying, hey, I make $250 a year or I make $100 a year, I am not growing that income usually in most plans. Again, just I'm not doing it. I don't want to assume any income growth, but any expense that I have or that a client says that they have annual living expenses, I am growing with inflation. So I have fixed income throughout the plan, but an inflation number, a spending number that's growing with inflation. And even, so $90,000 grown with inflation, but even assuming a 2.6% inflation number, by the time we get to 2074, that $90,000 is a lot. But we have the ability now, so as I'm building new plans, so not sure where inflation is going to be this year, this time next year, we're obviously going to see that help that go up or be around where it is, I think, over the next 5, 6, 7 months. But we do have the ability to override those inflation assumptions too. So if clients are super concerned about inflation, or they're, hey, Rob, I want to assume that we're going to be in a 5% inflation environment over the next 40, 50 years, we can override those assumptions and put that inflation assumption in specifically. We could tailor it to whichever number you want. Is there any place for annuities in Altrius plans? I don't know if you're teeing me up there, Mr. Skrotsky, or not. I personally haven't seen many annuities that I'm a fan of. It's nice to have a certain guarantee of income, but those guarantees, they're not always a guarantee. You got to look at the institutions that are providing those annuities. If they go bankrupt or something happens to them, that annuity guarantee doesn't mean anything at that point. They also come with a lot of expenses. The investment options are costly. There are lockups to them. So I would be, when I'm doing financial planning for clients, what I want them to be able to enjoy is financial freedom without needing an annuity. So plan to be your own annuity, and not have to buy a financial product that is oftentimes great for the salesperson, not necessarily always in the best interest of the client. Mortgage rate expectation for 2022. I am not a. I don't think any of us here at Altruist are. None of us have that crystal ball. If interest rates are going to go up, it's likely that mortgage rates are going to go up as well. Everything's kind of based off of 30-year Treasury numbers. So if that starts to tick up, of course, mortgage rates will go up as well. Some of the people in the financial world that I'm following are starting to take a more contrarian view. And I think there is kind of a growing number of economists and people out there that are saying, hey, we're in a race to zero long-term interest rates. If that happens, then obviously mortgage rates will still come down as well. So not sure how that will all shake out. So we'll just we'll wait and see. Ways to help aging parents. There was a question here: are there ways to help aging parents? Of course, of course, there are ways to help aging parents. It depends how much you want to help them and what their situation is. So without knowing more specifics in terms of vehicles to help aging parents or investment options to help aging parents, there's no magic formula. There's no magic investment option. It really comes down to, hey, what are the ways you want to help? What are the ways that they need help? Building a plan around that, and then coming up with an investment portfolio that's going to help achieve those goals. All right, so we're just about at the hour mark. I'm going to unmute the lines. If you want to ask a question, we are all ears.
Hey, Rob, it's Chris Skrotsky.
Hey, Chris.
I just wanted to say thank you very much. We've been listening intently, and this has been an excellent presentation. We appreciate it very much.
I'm sure the wine helped, but thank you. That's very kind.
Well, perhaps that's a factor, but indeed, we do appreciate everything you do.
Chris asked me if I wanted to pose a question, but I said, not after that much wine.
Okay, we're going to mute ourselves again before we make a mistake here.
Hey, Rob, are you able to send out your handouts with the information after this webinar?
Yes, absolutely. So not only will we send out a link to the recording, for everyone that's been on, but I'll also send out the deck as well.
Thank you.
You're welcome.
Hey, Rob, Guy here.
Hey, Guy.
Question. What is Altrius thinking about all this craziness with the COVID coming and gone with different strands here and there? And every time we turn around, the market goes down, the market goes up. I mean, it seems to me this is like a flu shot. Things get worse every year to year and you come up with something. But with the COVID, it's like as soon as something comes out, it's bad. The market just goes through the bottom.
Yep.
Any idea what's really going on or what are they thinking?
So in terms of our thinking, the market is the market is long term. It's a great indicator of where things are. But in the short term, it's a completely irrational place. So it's going to overreact to things both on the negative side and on the positive side. So with new variants coming out and anyone that wants to offer up an opinion or talking heads and pundits saying it's going to be worse than Delta or it's going to be better than Delta, based on how the market trades these days, which it's all computers and it's all algorithms and they're all searching every written word and all these research publications and all these opinions, it's trading on that sentiment. So when a new variant comes out and people say it's going to be the worst thing ever, the stocks are going to sell off in the short term. It's still our long-term belief, and you kind of hit what we think is going to be the case here. Long-term, we think it's going to be around with us. It's going to be like the flu shot. Probably going to need to take some type of shot or booster every year in order to live with it, much like we do the flu. It's just going to take a little bit of time and a little patience before we get to that kind of equilibrium. But I think, at least I'm seeing some encouraging things from leaders around the world where they're not going into lockdown mode because of this. I think because of how long it's been around already, COVID and a couple variants, we need to get to a place where we can live with it. And that means not shutting down and not harming the economy, which harms individuals and countries and in a number of different ways as well. So long term, I think we're going to get through COVID. It's going to become less of an issue. We're going to learn how to live with it, and that's going to be that. But until then, it's still probably going to be a bumpy ride should more variants pop up.
Okay, thank you.
Outlook for oil prices. Again, that's where I have no idea. There's a lot of factors that go into that. It's really tough to predict or time. We've had really smart guys and gals in the industry following oil a lot more closely than I do, making their living off of tracking oil and building funds around the price of oil. They come out and predict oil prices all the time, and 99% of the time that they're wrong. So I hesitate to even venture a guess because it's just I have no idea. Honestly, your guess is as good as mine right now. You just got to see how it's all going to play out.
Hey, Rob, given your previous comment about the COVID, are we invested in any of the pharmaceuticals that have the vaccines developed and that are working on the anti-COVID pills and so forth?
Sure. So we have Pfizer, we have AstraZeneca. So we have a lot of healthcare, and opposite on the energy side and inflation side too. We also have investments in energy that we are looking at as a hedge, a partial hedge. It's not going to be a full hedge, but should inflation or energy prices continue to go up, we do have exposure there that should go up as well and hedge some of that inflation risk or energy price risk. All right. Well, if there are no other questions, I know Jim just sent me a comment too. Jim's the portfolio manager. He's the big economist, CIO, and he loves talking about this stuff. So if you have any questions or things you want to talk about that are more specific to certain areas of the economy, reach out to us. We can connect and set you up and have a conversation. Again, I love talking about this as well. It's all topics I talk about with clients all day, every day. This presentation definitely more geared towards planning and what our capabilities are there. So if you're interested and haven't built a plan with us yet and want to go through that process, please reach out. Would be happy to do that and go through that exercise with you. And also, obviously, it should go without saying at this point, but anyone that you know, friends, family, who you think this might be useful, have them build a financial plan and work with a financial advisor on doing so. We'd be happy to talk with them, or at the very least, if they're just interested and you think they might think eMoney is an interesting tool and use that to aggregate their financial lives, and instead of going to 19 different websites, use eMoney as their centralized hub and to link all of their accounts. At the very least, we'd be happy to set them up with an eMoney profile that comes with no cost or anything like that. We'd be happy to help and set someone up that you think might be interested there. So don't hesitate to reach out. All right. Well, with that, thank you everyone for taking the time to come on. Really appreciate everyone and cooperating and giving us their attention. Like I said, we'll follow up with a link and we'll follow up with the information as well. But in the meantime, if you have any questions or anything you want to talk about, reach out to me, reach out to Lauren. Bye, Marilyn. And we would be happy to discuss further. But yeah, everyone, thanks a lot. Thanks again, and have a great night.
Bye.
Thank you, Rob. I hope you all have a Merry Christmas.
Merry Christmas. Yep. Happy holidays.
Yeah, Merry Christmas to all.
Thank you, Rob. Good night.
You're welcome. Good night.
Thank you, Rob.
Thanks, Rob, Lauren.
You got it.